So this is Derek Jensen. We're going to talk today about the Washington capital gains tax, and our agenda has been is presented here. We're going to talk really about the background of the tax, a little bit about how it works. We're going to look at a few different options for this. We're going to compare the just sell and reinvest option, and we will talk also about using a non-grantor trust or a charitable remainder trust. Our presentation will be about a half an hour today. At the end of the meeting, or the presentation, we will have some questions. During the meeting, I do have some little tidbits and extras that aren't really on the slideshow. So I'll be presenting that along the way, and we can get into it a little deeper when we get in there. So let's jump right on into it. So first of all, let's look at the capital gains tax strategy with just comparing an outright sale. So first of all, what is the Washington capital gains tax? Where did it come from? Well, this tax was initiated back in January of 2022 and was set up as a 7% excise tax. There was litigation on the tax that started in 22, and it ended up going to the Washington Supreme Court, where in 2023 we ended up getting the Quinn versus the state of Washington decision, which determined that this was an excise tax and not an income tax, and therefore was valid under the Washington state constitution. So since then, we've had this tax to consider. And there's been there was an attempt to repeal it and get rid of it that failed kind of significantly by a 64 to 36% ratio in 2024. Today, we have a new addition to this tax, which came through earlier this year, and that is effective for this entire year, which is that there will be an additional 2.9% surtax on top of that 7%. And that's for these high value sales of capital gains. So what does that mean? Well, on a typical sale, then I'm using a $10 million example here with a $1 million basis, there'd be $9 million in capital gains proceeds. The first 270,000 or so would be exempt from Washington tax, and then we would start to see that 7% tax come on for the remainder, and also the 2.9% would come in after the $1 million of gain. You do have one deduction available to you here, which is that charitable deduction. That's only going to work if your charitable deductions are greater than the base amount there of the exemption of 270,000. So in our example here, and again, these numbers, the 270 is indexed for inflation. You would be looking at, I believe it's actually 275 for 2025. So we'll confirm that. But you will be looking at an additional having to have over 300,000 of charitable gifts before you're able to get a deduction or so. So if you had a full 108,000 over the exemption, you would get a full 108,000 charitable deduction. So a significant amount of charitable giving required. However, there are a number of other things that work into it. Have a clarification from the state that qualified family-owned small businesses will get a deduction, and there's a few other rules there. So your results may vary a bit. Okay, so our first strategy for dealing with the Washington capital gains tax is we've got to figure out what it would actually be for a situation. And so in this example, again, we are looking at the sale of a $10 million of stock, of appreciated stock, with a $1 million basis. And I'm just using these numbers because they help to present it so well. Your results could be different. And again, it is important to recognize that the capital gains is really going to be, for the most part, on though the stock portfolio. It's not on real estate. And so after your after taxes, so after paying the Washington State estate tax, or excuse me, Washington State capital gains tax and the federal capital gains tax and the surtax at the federal level, you would have just a little over 7 million left. So nearly $3 million of taxes on that sale. After 1 year of investing at 7%, that'd bring it up to about 7.51 million. 10 years after the sale, you would be at 13.8. So that's kind of the baseline that we will be using from now on. So what do we know about this baseline? Well, first of all, it gives you immediate liquidity and diversification. And so that's a benefit. Also, it's simple. There's no complexity involved. You don't have to have a visit to the attorney for that. So that's a good strategy from that perspective. Of course, you're also getting hit with the highest Washington and federal tax hits. You're not getting a charitable benefit, and you're not getting any asset protection here. How does this compare to other states? So Washington now has a capital gains tax, and if we look around other states in the West, we'll see that others also have capital gains tax. California, for example, has a capital gains tax of up to 13.3%. Oregon has one up to 9.9%. There's a 2.5 in Arizona, 4.5 in Utah, 5.3 in Idaho. And so as we kind of look at those numbers and we think about places we might move to avoid the Washington estate tax, we'll see that not only might you be subject to income taxes in those states, but you may not be completely giving away from the capital gains tax. So it's one thing to consider as far as trying to move. So our first strategy we're going to consider is the use of a non-grantor trust. And I suppose will have to explain what a non-grantor trust is. And to do that, let me just show you our chart here. So in some states where there's income taxes, like say California, one technique that came around was something called an incomplete gift non-grantor trust. And what that allowed is, for example, a California resident to have income show up in an irrevocable trust that they would still have some control and benefit from, but it would be in a jurisdiction like, say, Nevada, and therefore they could avoid some of the California tax. And this is a fairly popular strategy in those higher income tax states. Here in Washington, we don't have the income tax. However, we do have this capital gains tax. So one of the questions was, well, could we use a similar technique here in Washington? And they took care of that when they passed the law. They said, nope, if it's an incomplete gift trust, it will be included in your income, and you pay the capital gains tax on it. So that one doesn't work. And so instead, what we're looking at is really a more traditional irrevocable trust. And so an irrevocable trust could be created for any beneficiary that you may want to benefit. It could be your spouse, it could be your children, it could be a neighbor for that matter. It doesn't really matter. But when you make that, what you're doing is you're actually making a completed gift. So you're giving up right control of those assets when you transfer them in, and they are out of your estate, both for income tax purposes and for federal gift tax or estate tax purposes also. Not only that, when the sale happens, then that trust has its own tax ID number, and it'll have its own income tax return. And that return is known as a 741, very similar to a 1040, excuse me, not a 741, a 1041, very similar to a 1040 that we pay our ordinary income taxes on. And the trust will also have its own deductions and the like. However, the brackets in the trust, there is an important distinction there. When you have one of these trusts, the brackets are compressed. They're the same brackets we have for individuals, but they're much compressed. And also, it will always have that additional 2.8% surtax on that. Finally, we will see that any distributions from that kind of a trust to the beneficiary will be considered a deduction on that income tax return. And that's kind of the nature of one of these trusts. It's a very common structure. We call it out here and say, well, it's a non-grantor trust to make the distinction that it is not a trust that would be income taxable to the grantor. Irrevocable trusts that are taxable to the grantor are also a very popular planning technique. One of the most popular is what's known as SLAT, S-L-A-T, which stands for Spousal Lifetime Access Trust. In this version, though, we're going to have to make sure that it's a non-grantor trust. So it's not going to be included for income tax purposes in the grantor's tax return or the spouse's return. And I guess I should point out there, Washington, that Washington exemption for the Washington capital gains is for an individual or for a couple. So you don't get to double up on that. I may not have mentioned that one earlier. Okay, so what's going to happen here? We're going to create that irrevocable trust. We're going to transfer the assets into the trust. The stock will be sold, and the trust itself will pay the tax on the trust, pay the capital gains tax. In this case, it's just going to be the federal capital gains tax. Washington does not tax trusts, it only taxes the individuals. And then you can, if it was the spouse who's the beneficiary and the trustee, like in a slant here, that's great. That is perfectly permittable. One additional estate tax benefit to this is that this plan would also remove those assets from the federal and Washington estate tax consideration. So if you have an estate that might be taxable by the state of Washington, this would also help to reduce your estate tax. Okay, so what are the advantages of this type of planning? Well, the first is that we're going to avoid the Washington capital gains tax, and we're only going to have that federal tax. We're also going to have the ability to provide some asset protection and what I was just speaking about of the estate tax planning also. And then you can have control over still who's the beneficiary, how they're going to receive those assets, what the timing of those gifts are. Considerations, well, it's a complex plan. It's an irrevocable trust. It's going to have its own income tax return. So it's not a super easy, but it is a workable and very tried and true tool. What would the outcome look like? Well, here we can see that instead of having to pay the full amount of the Washington capital gains tax, we're going to be able to reinvest or get that money back. We're going to reduce the tax then by about $800,000. And after year one, we'll have 1 million. And after year 10, if it was reinvested at 7%, we'd have 15.46 million. So better results all around than the outright sale. Whenever we're talking about income taxes, we are always looking at marginal benefits here. And so really the marginal benefit is nearly 9.5% of tax savings for this particular situation, and then a decumulated benefit over time. So that's how we see this as a benefit. So another popular technique to consider really is charitable giving. And one of the techniques that we can use there is the charitable remainder trust. And let me just show you how a charitable remainder trust works. If you're not familiar with a charitable remainder trust, it's what we call a split interest trust. Essentially, you're going to be making a gift into a trust, and that trust then has a provision with, at the end of some period of time, the money or the gift will go to charity. So it's a delayed gift for the charity. However, you, during the time frame between now and then, get to receive a stream of income back. And so that's why we call that a split interest. You're getting an income interest. The trust or the charity is getting a remainder interest. When you do that, it is a current gift and it is a gift to charity. So you do actually get a charitable deduction too. And so that deduction will be equal to the current value of the current value of the future, excuse me, I'm not saying it correctly, the present value of the future gift to charity. Also, there's really three variables that are going into this. How long will that trust last? And what's your payout going to be? And then what that charitable deduction will be. And there's a calculation that's used. For years, this has been a little bit of a, not an unpopular technique, but not quite as popular as it had been in the past. It does well when we have high interest rate environment. So right now, comparative to the relative really to what we've had maybe 4 or 5 years ago, our interest rates are higher and the math on this really seems to work out pretty well. So how long could the trust last? Well, it could last for your life. It could last for the life of you and your spouse. It could last for a term of years. You could add in a term of years plus your life. And so there's a lot of variation on that. And typically with today's interest rates, we could see a trust lasting between 50 and 60 years at the most. The other constraints on that would be our payout rate that's coming back to you, and also what that charitable remainder amount has to be. So the remainder that's going to charity must be at least 10%. So that is, if you put in a $10 million gift, the minimum amount that you would have as a charitable deduction would be $1 million, but it could go up from there. Additionally, you must take out at least 5% a year. So if you were trying to maximize your charitable deduction, you would set it at 5%. If you were trying to get more of the value coming back to you during the income period, you would set that at a higher. And so those numbers can be played with back and forth. In any event, because it's a charity, or it's considered a charity, when it sells the stock, there is neither Washington or federal capital gains tax that is going to be paid on that sale. So the full amount of that, the full $10 million in our example, would be able to be reinvested inside the trust, and then you'd be getting your amount coming back. Eventually, when so for example, it's very common to do a lifetime trust, a trust that'll pay out the funds out to you for your entire life. So at your death, it would end up going to charity, whatever's remaining in the trust. So what are the benefits of this? Well, the benefits are that you'd be eliminating that Washington and the federal capital gains tax. You're going to be able to put more of that money to work in a tax exempt environment. And you're going to be able to get that charitable deduction right off the top. And if you do have those charitable goals, these funds can be used to really help you fulfill those goals over time. Again, it is an irrevocable trust, and so once it's in there, you can't access the principal. You have the rights to those, the percentage, the payout percentage, but you are going to be controlled on really what you can and can't do, since this is going to be a regulated type of trust. It will be something that is looked at, historically has been looked at by the IRS, and there are significant rules that go along with it. The income that comes out to you will come out as ordinary income if it's like interest. But you can also get some capital gain coming back out to you. So if for example, you just were investing in growth assets inside of there, um, you would get capital gain coming back. So it could potentially trigger more Washington capital gains depending on your situation. So what would this result look like? Well, here you see that we've set it at a 6% payout coming back to you. This would generate 600,000 per year, and over at 10 years out, we would be looking at about $6.16 million coming back to you, and there would still be $10.6 million in the trust. So that 600,000 per year would be continuing really for the entire length of the trust. It does go up to the 600,000 the first year, but it's a percentage based on the value that's in the trust each and every year. The other nice thing about this is that it would create a $2.67 million charitable deduction. Since we're putting in investable securities, that's going to be limited to up to 30% of your adjusted gross income. However, you can take it either this year or up to 5 years carryover. And so that's what we're going to get for that deduction. You may not be able to use all of the deduction. So that's one of the considerations too, is are you going to be able to use that? We've had situations where we've actually combined this strategy with, say, doing a rollover of a traditional IRA into a Roth to increase the amount of taxable income so that you can have a deduction. Okay, so let's go ahead and compare these side by side and look at what the results of the three strategies that we're really looking at today. And then go in and we'll start looking at some questions. And I do have a few other points that I can present here too. So as we're looking, we can kind of see the baseline result, the charitable remainder trust result, and the non-grantor trust result. Clearly, there's going to be more funds available in the non-grantor trust since available to the grantor, to the owner of the stock, since, well, not to the owner's stock, available to your family, if you will, since we're not paying the Washington capital gains there, tax there. The charitable remainder trust, however, is going to be presenting a gift to the charity, and it's going to get you that charitable deduction. So over time, both will end up beating baseline of just selling. So how do we make a decision on which of these techniques makes the best sense in your situation? Well, really, where are we going to put this? If you do have some beneficiaries who are out of state, or you want to move out of state, we could even create a trust that's in another jurisdiction potentially. Might not have the same kind of income tax issue with that. You have the charitable goals. What are you needing these funds? Are you going to need to be using them right away? Are you really looking to reinvest? Are you concerned about the complexity, or are you really just trying to reduce the amount of taxes? What's your time horizon? Those are some of the considerations. All right, so what are my key takeaways today? Well, first of all, the Washington capital gains tax can materially reduce the proceeds from a sale, and so planning matters. Let's look at that. Let's consider that before we just go and sell a large holding. A Washington non-grantor trust that is a completed gift trust can help us to eliminate the Washington capital gains tax, but it does add some complexities. A charitable remainder trust can deliver philanthropic results for you, really complete your estate planning for any charitable type of planning you're attempting to do. But ultimately, we need to know what your goal is, what you're trying to accomplish, before we make a final decision.